The Indian banking sector is facing a crucial moment. With a sharp increase in credit demand, banks have been extending more loans than before. To highlight this issue, the Reserve Bank of India has released the RBI Bulletin for the month of August and stressed on this fact. Let's understand what exactly is happening in the Indian banking sector. So to start off, let's understand how a bank works. Banks take deposits from customers and pay them a low interest rate. They lend these funds at higher rates, earning a profit. Besides lending, banks invest some deposits in bonds for liquidity and keep a cash reserve as a safety buffer. This balancing act or strategy allows banks to generate profits while also ensuring the security of customer deposits. Now, for years, Indian banks have been enjoying a comfortable credit deposit ratio or CDR ratio, a metric that indicates the proportion of deposits lent out as loans. A higher CDR generally implies better profitability. However, as you can see on the chart, the credit growth has stood at 13.7% while deposit growth lagged at 10.6%, indicating a mismatch. And now, to meet the ongoing credit demand, banks have resorted to issuing certificate of deposits in large numbers. In fact, certificate of deposits amounted to 3.49 lakh crore rupees during this year up to August 9th, significantly higher than 1.89 lakh crore in the corresponding period of the previous year. While certificate of deposits are a quick source of funds, they come at a higher cost compared to traditional deposits like savings and current accounts. This widening interest rate differential is squeezing banks' net interest margins. Now, the RBI's stern message is clear. Banks must keep a check in their credit growth to match the pace of deposit mobilization. This recalibration is essential to safeguard the banking system's stability and protect depositors' interests. Moreover, a few banks like Punjab National Bank, Bank of Maharashtra, Union Bank of India, and Central Bank of India are all awaiting shareholder approval for fundraising at their upcoming annual general meetings to strengthen balance sheet and support expansion plans. Now, as mentioned earlier, the growth of deposits have been subdued across the country and recorded a growth of 11.1% on a year-on-year basis and a mere 1.8% growth sequentially. Banks have resorted to certificate of deposits and commercial papers to gain access to funds to lend out. While this is a quick source of funds, it comes at a higher cost, squeezing the bank's net interest margins, which is the difference between the interest income on loans and the interest expense on deposits. If you see the image on the screen, the net interest margins have been squeezed over the quarters. SBI Bank recorded margins of 3.35%, a decrease from 3.43%, while ICICI Bank, on the other hand, recorded margins of 4.36%, again a decrease from 4.4%. Now, going forward, the net interest margins are expected to be under pressure in the following quarters of fiscal year 25 due to the higher cost of funds and a deliberate slowdown in unsecured loans. Lastly, we need to keep a watch on the credit deposit ratio, as banks will strive to strike a balance between the credit and deposits to mitigate liquidity related risks in the future. Having said that, this is me, Rahul, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.